Hi everybody and welcome back to the channel. Since my last update, the Bank of Canada has raised their interest rate and they've raised it by 1%. So this is the largest increase, biggest jump since 1998. So quite the while. The base interest rate has gone from 1.5% to 2.5, and you can see we've had low to almost non-existent rates for a long time, and this is definitely going to affect the stock market. We can already see that it's affecting real estate as the sales of homes have declined by quite a lot, just because if you want to get a mortgage now, the mortgage payment you have to pay is going to be much higher. It's simply just more expensive to borrow money, and that's generally not good for stocks in general either. But the bright side is that oil seems to be declining, and commodities seem to be slowing down. So there's hope that inflation's cooling off, and then hopefully, if that happens, then the interest rates will stop increasing, pretty much every other month. And another update with my portfolio is I've actually invested in a Canadian growth stock. So I'll be heading into my portfolio update for the week. And if you want to follow along with the journey, please like and subscribe to the channel. We're almost at 500 subscribers. So please subscribe if you aren't already, and share the video, and we'll get into the intro. So in the TFSA for Thursday, the 14th of July, we are down $95.16 or 1%. Past week has been pretty brutal. There's a good reason for that. I'll be going into that in a moment. Past month, we're actually up 1%. Past 3 months, we're down 12%. So it's been a very rough time for the portfolio. Just as the market is selling off indiscriminately still. Again, it does not matter where you're invested, things are going down and selling off. For the 1 year, we're down 8%, and then all time, we're down 6% or 873.79, but we're still collecting dividends, we're still increasing our passive income, so I'm keeping my eye focused on the long-term goal that, this portfolio is simply to create a stream of income for me. And let's go into the holdings. So Apple has actually jumped back into the green. So technology actually had a pretty good day today. So Apple's doing nice. Glad I stocked up on it while it was in the low 140s. Very happy that I added more to this. It seems to be stabilizing now. We'll see where it goes in the at least later in the month, just because Apple is going to be announcing their earnings at the end of this month, so we'll see how that happens and how that affects the stock. That'll be interesting to see. We have Algonquin Power, kind of hanging in there. It's not dipping as much as the rest of the market. It's still paying us good dividend income. And the new stock in the portfolio is actually Aritzia. So this is a clothing store, a high-end clothing store, so a luxury one. And the reason why I decided to invest in this is that it's a small company in Canada. It's only has about a $4 billion market cap, so it's a very small company. They have a strong balance sheet. They're highly profitable, and I just researched it. I just think they're at a very good valuation, and I looked into a few things that I really liked about the business, and I think that they have a lot of growth potential ahead. So if we go into the investor presentation for Aritzia, you can see that, rather than going for the discount or the fast fashion, like kind of the Walmarts or H&Ms, Aritzia sits right below luxury and sub-luxury. So it's definitely a pricier option than the lower end of the market. And ordinarily, I'd say like the number one criticism of fashion would be that fashion trends change constantly, and it's very unpredictable. women could like your brand, and then not respond to it, next year, and then you kind of fade away. It's happened before. Forever 21 would be an example of that. But I actually researched more into the company, and I found out that they actually have staple clothing, so essentially popular products that are proven and time tested. So very timeless, basic pieces that you could buy. And anytime they try a new line of clothing or some kind of trendy thing, they'll make a small quantity, and then if that does very well, then they'll scale it up. And another thing with this company is that they're vertically integrated. So what that means is they source all their materials, they own all the brands, they control the distribution, they own the warehouse that makes all the clothes, and they ship it out to all their stores. So very, very efficient business. And they also use technology. They're growing their e-commerce sales. They have a very good website that people like to use. You can order online. You can even order online and then pick up in store. There's a lot of great options that they're doing. So definitely using technology, and they use that pandemic to really, really boost their e-commerce, and now it's just all working together. So it's a great business. And then they also have all these little in-house brands that they have. So again, that increases their margin as well, because they're since they're not selling another brand's clothing, they can essentially have a higher profit margin because they are not paying a third-party company to supply them with clothes. They're kind of setting the trends, which is kind of nice, and they're definitely aware of what women like. And if we look at just how many stores they have, you can quickly see that they have about 110 boutiques. That's what they call their stores. And Canada has 68 stores. The United States is 42. You can see that in just in Toronto we have like 30 stores, and then in the United States you can see just they have very, very, very few stores. So there's a lot of growth potential. Not just in Canada but also in the United States. And they really are planning to expand in the United States and open stores, and they even have one in Honolulu, so that's pretty interesting. And so they have a lot of growth potential. And then in the last earnings report, they grew their United States revenue by a colossal amount. Like I think it's about 80%. So it's definitely the way forward. There's a lot of gray here. There's a lot of markets they're not in yet. So they're still building their brand in the United States. That's one issue I usually have with Canadian retailers. Like one that comes to mind would be Canadian Tire, because they tried to expand to the United States, but again, the problem is you're called Canadian Tire. You're not going to appeal to other markets. Aritzia doesn't have that problem, and if they definitely nail the United States, they have 10 times the population of Canada. There's a lot of growth potential here. There's a lot to like. If they can establish themselves as a brand in the United States, then they can move on to international, but they definitely are focusing on conquering North America first. And most of their growth is going to be from the United States just due to that larger population. And they're hitting, the very popular, cities in the best locations, the most visible to get their brand out there. And also their clothes are very popular, and they're being advertised, on TikTok, and celebrities like to wear their clothes. Like Jennifer Lopez likes their clothes, Meghan Markle wears their clothes. So that really, really helps speed up the brand and the growth that it has. And the CEO of Aritzia is Jennifer Wong. So she became the CEO in 2015. And the real inspiring thing about her as a CEO is that she started in the company in 1987. So she's been with the company for almost 35 years. And she started off as a styles advisor. So that's what they call their salespeople in their boutiques. And she worked at the Vancouver Robson Street boutique, and, worked her way up from the company from the bottom to assistant store manager, VP of operations, chief operating officer. And then in 2015, she was named the president of Aritzia. So she's the current CEO. and she's kind of seen it all, like over 3 decades of fashion trends. She definitely knows how the store should operate, and just as a CEO, and being in a bunch of different roles throughout the company, she knows how it functions. So she's definitely a great leader. She's not the founder of the company, but she was promoted and worked all the way up to CEO. So very inspiring story here. You can start from the bottom, and you can become a CEO of a company if you work hard enough. And Aritzia has been doing very well under her watch. They've been growing very, very fast, and she's very aware of technology as well. And in the earnings call, she mentioned that they were targeting much, much larger stores because a lot of the real estate in these larger real estate in prime locations, people are afraid of them, and they're getting really, really good deals on them. So she believes that they're a great way to, get some cheap leases, get some cheap land for the stores, and just grow the brand like that. So they're definitely not afraid. And another thing is they've never closed one of their stores. So if that doesn't speak to quality management, I don't know what does. I can think of any other retailer. They've shut down stores before. Aritzia has not done that once. So they definitely know what a good location is, and they said they have many, many different locations in mind to expand. So that's very, very interesting and exciting as an investor. And they gave guidance to grow about another 26 to 30% in the upcoming year. And the stock has just plummeted from its highs. Like it pretty much fell in half. But I actually think, with all the hype kind of gone out of the market and out of the stock, it's actually very interesting investment. So I just got 2 shares to start. I'm definitely planning to purchase a lot more. Because from my numbers, and at least from my opinion, I think it's about a $50 stock. Again, do your own research, make your own decisions, but I'm going to go ahead and continue buying this. And if we go to the rest of the portfolio, we can see that Scotiabank has taken a beating. All the Canadian banks have pretty much declined. And that kind of stems from JP Morgan revealing their earnings, and they had a decline in their revenues. So people are definitely scared of the Canadian banks also facing, a similar decline. But I do want to preface this by saying that the Canadian banks have never missed a dividend payment in 2008, even in the financial crisis. So that was like basically the worst time and the ultimate stress for our financial system, right? And the Canadian banks were fine. They're not American banks. That's just something to keep in mind, even though people pretend that they're exactly the same. So I think these are completely oversold right now. I think they're good buys. They could definitely go lower, and if they do, I definitely want to continue averaging, even though they're still large portions of my portfolio. I'm totally comfortable adding more of these and holding them for the long term, maybe even to my retirement. So not worried about these. I buy these and I sleep very, very well at night owning these. I'm never concerned about it. I never worry about the price that it's at. If it's lower, that's just a chance to get more, and we're going to get our dividends at the end of the month. I'm just going to reinvest it and get more Scotiabank. So definitely very, very excited to do that. And we also decided to pick up more of our income funds. So I went up to 100 shares of DFN. This is absolutely tanked. This is about $8. Now it's down to $6. So I decided to go from 90 to 100. So that'll give us more income in the portfolio. And we also picked up more Google, like I planned. This is actually going to split tomorrow. So the stock price will be a little bit over $100. So essentially, you're just getting each share of Google turns into 20. And I also think Google's trading at a pretty attractive valuation, so I decided to buy more of that. HYLD, I bought 3 more shares going up to 70 because it's giving us over a 12.5% yield. And with Microsoft, I've just been using little dividends here and there. to dollar cost average into this position. I really focused on Apple because I really thought that was a better value, but now I kind of want to get a little bit more Microsoft in the portfolio. So we're just averaging into this as I can. And same thing with TD Bank. It's been going down immensely, but definitely going to be interesting to get more because TD Bank doesn't usually have a dividend yield of 4.5%. Scotia's at over 5.5%. If these go up over 5-6%, I mean, I may just have to buy, a share every month or two, just pick it up and just keep averaging up into it. Even if I become overweight in it, I really like focusing on sectors that are out of favor. And if that's going to be technology and financials, then I'm going to have a portfolio that has a lot of financials and technology. And, when that turns around, maybe we'll go into consumer staples if those ever come back down again. As it is right now, I think that financials and technology are probably where you want to be. Maybe tech might be a little better right now just because financials are all getting hit across the board, but we don't know where the bottom is. Nobody can tell that. So if you see a good deal and you're planning on holding a stock for 10 years, maybe 20 years, 30 years, don't hesitate to buy it if you think it's at a good price. And if you are scared of the market falling, you could just do what I'm doing, just dollar cost average every week. So, you don't know where the price is going to head up. If we recover, at least you got some at a low price. And then Tesla's also going to report their earnings on July 20th. So this will be a pretty big deal. I've been holding off on getting more Tesla just because they are having a bit of trouble with their manufacturing and their new plants. They're not quite as efficient, and they're still having issues in China. So we'll see what happens there. If it really falls, I may look to add more to it. But as of right now in my portfolio, I'm going to focus on picking up a lot of Aritzia because I think that's one of the most attractive opportunities. At least in my portfolio, I think Aritzia and Intel are probably the best values relative to the growth that they can give, at least in the next 5 years. Just following along with the dividends earned since starting the portfolio, I've earned $606.57 in dividends since starting the portfolio. Annually, we're earning $802.84 per year in dividend income versus our previous update, which we earned $787.48. Every month, we're making $66.90, and last month it was $65.62. So we're getting closer to our goal of hitting $3 a day. So we just need to hit a little over $90. So we're going to just do that dollar at a time. We're going to deposit. We're going to reinvest our dividends. This number will continue to go up no matter where the market goes in the short term. And then every week we're making about another $15.44 versus $15.14. So extra 30 cents a week doing nothing. Daily we're making $2.20 a day versus $2.16. So an extra 4 cents a day. And it's taking us 1.49 months to earn $100 versus 1.52. So this number's shrinking. And if our portfolio was out there working a job for us 40 hours a week, it'd be bringing in 39 cents per week. But keep in mind, you're not going out there earning that. Your portfolio is. And the more and more money you have, the more that passive income will increase over time. And it just builds upon itself and snowballs out of control. So just keep at it, especially if you're a new investor or you're thinking about getting into it. Just remember that, it's a long game. Just keep tracking your dividends over time. You'll see that they grow. And no matter where the market heads, they will continue to grow. Just invest in quality, invest in your index funds, however you want to do it. If you want to get started, you can feel free to use my link for Wealthsimple in the description below. So if you sign up for that, make a deposit into a personal account, they can give you the value of a couple $1,000s worth of stocks. So definitely a good way to get started, and it's a way to support the channel. And let me know in the comments below what your biggest dividend payment is for the month of July. So for me, it's going to be Scotiabank. It's going to be about $19. All right. Don't forget to like, comment, and subscribe, and have a good day, everybody.